Well, good afternoon and welcome to today's webinar on dairy risk management options. A special thanks to the New York Farm Bureau that is a co-sponsor of today's webinar. In setting the stage for today's webinar, certainly everyone on the call understands the current dairy situation. We've had an extended period of weak milk prices, which is causing financial stress on many dairy farms. So the programs we're going to discuss today, they're not a magic bullet or a cure for low prices, but they do represent a set of tools and options for producers as they manage risk, and including a new dairy revenue and crop insurance product that we're going to discuss today. It's good to have options, but sometimes having options can cause confusion. And so one of the main goals for today's program is really to help participants understand each of the programs, but also how they relate to one another. And finally, at the end, we're going to visit with one of our business consultants who works with producers regularly and really help to discuss how to analyze those options. So we're pleased to be joined today by a group of subject matter experts to help us navigate the various options. I'm going to go ahead and introduce all of them here at the beginning and then turn it over to our first presentation. So first, to discuss the new dairy revenue crop insurance policy, we're going to hear from Zach Hyland. Zach is the marketing supervisor for Rain and Hail, primarily focused on the mid-Atlantic states, and his current focus is bringing the dairy revenue program to market on the East Coast. So certainly a good selection in terms of our presenter today. Zach's been with Rain and Hail since 2014. He's a 2012 graduate of Wartburg College in Waverly, Iowa. He's a native of Iowa and currently based out of Richmond, Virginia, so we're glad Zach could join us today. Then we're going to hear from Jeremy Ferret. He's the manager of Crop Growers Insurance Agency, who's been with crop growers since 1997. Jeremy oversees a team of 26. They serve almost 1,900 producers and 650,000 acres, producing 34 different crops. Since 2002, Crop Growers risk management plans have helped result in $320 million in payments to Northeast producers. Jeremy is a Central New York native and a graduate of Class 8 of the Lead New York program, and he's going to discuss the livestock gross margin insurance product for dairy, or better known as LGM dairy. Following Jeremy, we're going to hear from Clark Putman, the New York State Executive Director for the USDA's Farm Service Agency. He's going to provide an update on the Margin Protection Program. Clark served as the County Executive Director for St. Lawrence County for 29 years. He's a graduate of Cornell, and he and his family operate a 70-cow dairy in Madrid, New York. Clark, we're glad that you could be with us today. And then finally, following the discussion of dairy revenue, LGM dairy, and MPP, we're going to hear from Farm Credit East business consultant John Lair. John's a graduate of Cornell, where he got his BS in animal science in 1990. He's been with Farm Credit ever since, serving in a variety of roles, most recently as a loan officer, and for the last 14 years as a business consultant, working with producers on profitability, estate plans, and production management. John grew up on a part-time farm in Jefferson County and now lives in Morrisville. And so we look forward to getting John's thoughts later on how producers can evaluate their options. So now I'm just going to show the legal disclaimer. And as I do that, I just want to make a couple of reminders. As Heather said during the presentations, if you go to the GoToMeeting control panel, the red arrow is where you can text chat in a question. I'd also note that also on that control panel are PDFs of the presentations for review later. And as Heather said, this is going to be recorded. So for folks who want to revisit it or share it with others, that will be available afterwards. So with that, we're going to turn it over to Zach for his presentation on dairy revenue.
All right, thank you very much. All right, so we will go ahead and get started here. Thank you to the Farm Credit East team for having me. As some of you may know, dairy revenue protection is a brand new plan of insurance. Sales don't start for it until Tuesday, October 9th. But we have been training our agents about this. We've been training the crop growers team on it. And I'm really excited to get in front of some producers and be able to talk to the program from the company's perspective. All right, so starting off, the first thing about dairy revenue is that it is a policy that provides protection against declines in quarterly revenue from milk sales. It is a little bit of a departure from some of the other programs where you're looking at yearly or bi-monthly sales. This is a quarterly coverage plan. So we'll need to keep that in mind as we're going through some of the examples, that the numbers that we are using are for the quarter, the 3-month period that is insured. So this quarterly coverage can be sold up to 5 quarters out into the future. So it's a very forward-looking product. As we progress through the year, sales periods open up for the later periods, and when we get to the end of the sales period for a initial quarterly coverage. With dairy revenue, there are 2 pricing options, and this is one of the things that really gives dairy revenue a lot of flexibility to fit the unique needs of your dairy farming operation. The first of those is the class pricing option, which is going to take a blended average of the class 3 and class 4 milk prices in order to establish a guaranteed price for your dairy revenue protection policy. The second option is a component pricing option. And what this does is RMA, the risk management agency, they set values based on different components of the milk, namely butter, fat, protein, and milk solids. Based on the levels of components within the milk in your individual herd, you can insure on those values. This is a very, very good choice for some of the Jersey herds or other dairy herds that are producing higher than average butter, fat, and protein levels. The next point with dairy revenue is that the farmer is choosing how much milk production is to be covered during the quarter. There's no requirement to cover 100% of your milk. There's no minimum amount of milk that has to be covered either. What that gives us the opportunity to do is take out coverage at multiple different times for the quarter. And that allows us to capture, an initial price. And then if that price improves, you can lock in more coverage as we progress through the quarter. It's available in 70 to 95% coverage levels. So as you see coverage level, that's essentially the deductible. So on a 95% coverage level dairy revenue protection policy, that's a 5% deductible that you're looking at on that. And then lastly, it is indexed using state level milk production. So dairy revenue, like I said, is mostly a policy that protects against decline in quarterly revenue from milk sales based on the Chicago Mercantile Exchange prices. But to a smaller extent, the yields at the state or pooled production region, which I'll get into in a little bit, those are covered too. So if there is a decline in production, it's possible to trigger an indemnity through that as well. All right, so there are a number, and I think the whole group is going to, get into all these different plans. I'm certainly not qualified to speak to the MPP plan, but through crop insurance, there are 3 risk management tools that dairy farms can use. The first was whole farm. That didn't really work too well for dairy farmers because there was caps on livestock, and that excluded many, many dairy farms. LGM also had some caps. Jeremy will speak to the LGM program a little bit more. But there was other components than just milk prices involved. And really, in talking with customers when Farm Bureau developed this program, they were looking for that price coverage, and that's why Dairy RP was developed. And it's given the opportunity for a lot of flexibility and customization, which is the reason why I think this is a very, very strong addition to the risk management portfolio for the dairy farms. All right, so just a quick brief on LGM Dairy. It is federally reinsured and subsidized, just like the Dairy Revenue Protection Program is. It takes only the Class 3 milk price minus corn and soybean meal futures. And you could not participate in LGM if you were enrolled in MPP through the FSA. With dairy revenue protection, it is allowable to have dairy revenue protection and MPP covering the same milk. Dairy revenue protection and livestock gross margin, though, cannot be allowed for the same months covering the same milk. So I think the increased flexibility of allowing people who are enrolled in MPP to also have dairy revenue is another great component of this policy, and another reason why I think it's going to work for a lot of people. So when we are looking at buying a dairy revenue protection policy, there's really 5 main decisions that you as the farmer are going to make. Number 1 is going to be the value of the milk that you're protecting. I mentioned the class pricing option and the component pricing option. Based on those 2 choices, you're going to select either a blended average of the class 3 and class 4 milk prices, or if you're a farm that has higher than average component levels, you can use those component levels to set a value for your milk. The second choice that's going to be made is the amount of milk production to be covered. Again, there's no requirement to insure all the milk that's produced. You can certainly elect to insure all of the milk. The important thing to note is that 85% of the milk that you have elected to insure on your policy has to be sold, and there has to be records kept for that can be produced at the time of a loss and a claim payment. The third choice that the farmer is going to make on dairy revenue protection is the level of coverage between 70 and 95% of the revenue guarantee. I'll get into some of my thoughts on the way I see dairy revenue working best as we continue on. But I really do think that we're going to have to be looking at the 90 and 95% coverage levels when we're making these decisions. In order for this policy to work and for the insured to receive a payment on it, there has to be a loss in the market prices. At coverage levels below 90%, that means we're looking at more than a 10% decline in the market price, which based on current pricing, I don't know if that is realistic. So 90 and 95% coverage is what we should be looking at on those, in my opinion. The fourth decision is which quarterly contracts are to be purchased. So on October 9th, when we can start writing these policies and start locking in some risk protection for you dairy farmers, you're going to have the opportunity to buy this coverage up to 5 quarters into the future. I've got a slide that shows kind of how that works and how far out you can buy coverage. So what that allows is some long-term price stability. And then at each day that's the sales period, you'll have the option to buy 4 or 5 quarters out into the future. The last decision that needs to be made when a dairy revenue protection policy is purchased is the protection factor. What the protection factor is basically a claim multiplier. So in the event that a claim is paid, if a protection factor above 1 is elected, that means we're going to use that figure to multiply your claim and pay you more money. With the way the markets are now, it's very possible that the prices that are available are not going to be exactly what you need to meet your needs. This protection factor is a way to get paid a little bit more, with the trade-off that you do pay more premium. But it's a way to really increase the liability of your policy and be more well protected in the event of a market decline. All right, so our quarterly insurance period. So this slide is showing what months are available for sale at which days. So on 10/19, if you look on the left side of this slide, you are going to have the option to purchase coverage for January through March, April through June, July through September, October through December, and January through March of 2020. So like I said, it's a very forward-looking policy. Once we reach the end of the very first sales period, which ranges from October 9th until December 15th, on December 16th of 2018, we're going to open up the April through June of 2020 quarter that can be insured. This continues on. Every time we shut down sales for one quarter, we open up another one on the back end. So this is going to allow the dairy farmer to continuously ensure their milk production as we look forward into the future. So when you're meeting with your insurance agent about a dairy revenue protection policy, the first thing they're going to have you fill out is an application. So that application for insurance is there to provide the basic information that we need to write you a crop insurance policy, the tax ID, the entity name, and then for the dairy policy, we will also need the county that you farm in, and that's really about it at application time, just very basic information. When an application is filled out, no coverage attaches. You are not on the hook to sign up for anything at that time. You're simply just saying that, yes, I'm interested in dairy revenue protection. I would like the option to be able to buy this coverage when the price is available, meet my needs. When the day comes that those prices do meet your needs, or you get a call from your insurance agent again, and they update you with a new quote that they think will suit what you're looking for, we're going to fill out what's called a quarterly coverage endorsement. Quarterly coverage endorsement is what establishes your revenue guarantee, the liability, and the premium for your policy. So when we're filling this quarterly coverage endorsement out, that's when we're going to need to know how much milk you would like to be covering for that quarter, the coverage level that you've elected, the type of pricing that you're going to be using, the quarters that are to be insured, your share of the milk that is being produced on the farm, and then lastly the protection factor that I talked about. So that's the yield or the indemnity multiplier. With dairy revenue protection, expected prices will change daily. So what that means is RMA and the crop insurance companies are going to track the prices that are on the Chicago Mercantile Exchange each day. Fluctuations and volatility in those prices will change what prices are available for the dairy revenue protection plan of insurance. So I think it's going to be important, number one, for our agents to be on top of those market fluctuations, and also use dairy farmers. Through Rain and Hail, we have some tools available online through our policyholder services accounts where you can go in there and quote your own policies and see what those pricing changes are on a day-by-day basis. So I think there's going to be a number of ways that we can stay up to date on the most current information and be able to be very, very reactive when the prices meet the needs for our dairy farms. We'll be able to lock in coverage on that exact date. So like I mentioned, the Chicago Mercantile Exchange dairy-related options are used to create the market volatilities and create the premium rates for this policy. For those of you who carry revenue protection insurance on your corn, soybeans, or wheat, this is almost exactly the same way that those policies work, where a market price is set based on the fluctuation of the markets in that 3-month period. Since it is a market price being used, premiums will be higher during times when there's more volatility in the market. So if we have a lot of price movement and you're wanting to lock something in, you may pay a little bit more. I think you'll see in the next few slides that premiums and subsidies on this are very reasonable, and so I don't anticipate that high volatility is going to make this product unaffordable. Again, market prices are used all over crop insurance. as we're looking into the quarters that are further out on this policy, the prices will be a little bit higher, simply because the potential for market volatility is higher in those further away out quarters for insurance. Okay, so moving on to the yield components of this policy, I talked a little bit about state level production and pooled production regions in an earlier slide. So for the states of New York, Pennsylvania, and Vermont, the state level expected milk production and actual milk production is used. If you're a producer who falls outside of those three states in the Northeast, then you're going to be grouped into the Northeast pooled production region, meaning that the production from Pennsylvania, New York, and Vermont, in addition to all the other states on this slide in gray, will all be pooled together for production uses. So the reason why production is important for this policy, and it's indexed at the state level, is that production varying, the actual production varying from what was expected and set by RMA before the insurance period begins, does have an impact on the claim check. So in situations where there is more actual production than what was expected for the state or pooled production region, that means that the yield, that the indemnity will be decreased. The reason why that claim would be decreased is that on average, dairy farms within the state had more milk to sell. Therefore, the revenue decline is not as steep as what the price decline actually was. In times when there is less actual production than what was expected for the state, we're going to increase the claim payment, because that means that the average farmer within that state had less milk to sell. So even though there was a price decline, they were selling less milk, therefore they should be paid more on that claim check. These numbers are all collected by USDA and NAS, and then published at the end of the insurance period, and they'll flow right into the paperwork. So your insurance agents have it, and then in a claim situation, we provide all the documents to you, the insured, as well.
Hey, Zach, a question came in, just to stop you right there on the in terms of how often, there's a question that came in on how often NAS reports that.
Yeah, so at the beginning of the insurance period, those numbers are already set by RMA for the entire crop year, the expected production. The actual production that comes from NAS at the end of the insurance period, that comes out within a few weeks of the insurance period ending. So it is timely information.
And it is, and then that would be sort of the quarter. It would be kind of compared quarter to quarter. The NAS quarterly production would be, compared to what the expected was.
Yes, and that's how we arrived at this yield adjustment factor. Yep.
Okay, thanks.
Okay, so the causes of loss covered for dairy revenue protection. Again, this policy provides insurance only for the difference between the final revenue guarantee and the actual milk revenue multiplied by the share and the protection factor. The differences in the final revenue guarantee and the actual milk revenue will be caused by natural occurrences in the market prices and yields within the state or pooled production region. This policy does not cover against the death, loss, or destruction of any of the dairy cattle, disease, anything like that. It is strictly protecting against the loss of milk revenue and the loss of production at the state or pooled production region level. It's also important to note that this is a sold milk policy, meaning that the milk that you have insured on the policy has to be sold, and there has to be a sales receipt of some sort proving that sale. any milk that is dumped does not count for the milk production in order to meet your 85% threshold of providing records for the milk production insured. Okay, so our first example here of how this policy works is a situation where the final price came in lower than what was expected, and then the state's production was also lower. So at the beginning of our insurance period, when the insurance agent went out to meet with the farmer, that farmer elected to insure 1 million pounds of milk. Based on the averages of the Class 3 and Class 4 prices, that farmer elected to insure their milk at $15.81. That gives us an expected milk revenue of $158,100. This insured elected to go with 95% coverage, which allows us to arrive at a revenue guarantee of $150,195. Our protection factor chosen was 1.2. The share of the milk was $1, and then RMA's numbers for the expected milk production per cow in that state was 6,000 pounds. All right, so what these numbers, when we put them into the rating and quoting, that gives us a total liability of $180,234. The total estimated premium for that $180,000 of liability is $2,256. In that $2,256 of premium, there's a $993 subsidy. So that means that the money coming out of the producer's pocket for the insurance coverage on this 1 million pounds of milk for the quarter is $1,263. That's the producer paid premium. Okay, so when we arrive at the end of the insurance period based on the elections made here, NASS's data came back, and there was actually less production within the state. There's only 5,900 pounds per cow. So that's our first number. And the second item that happened is that prices fell. So initially we had $15.81 as our price. During the 3-month insurance period, prices fell to $14.90. At the time of claim, when we sent out the request for the records, the insured was able to prove that they sold at least 1 million pounds of milk during that insurance period, so that they are covered for the full amount. And that's 1 million pounds. All right, so based on this final milk production per cow being lower, we're going to apply a yield adjustment factor of 0.98. Our final revenue guarantee was $150,195, but the actual milk revenue was only $146,020. That gives us a revenue deficiency of $4,175. We multiply that by the yield adjustment factor. We multiply that by the share, and then by the protection factor. That gives us a final indemnity payment of $5,000 based on $5,000 and $5,010 based on those numbers. I think it's a good illustration of the protection factor and how the total revenue deficiency was only $4,175, but by electing this protection factor of 1.2, you as the insured are receiving an indemnity check of $5,010 in this scenario. Okay, so our second example here is very similar. All the numbers in the left-hand column are the exact same. But when we arrive at the end of the insurance period on this one, the insured they overstated the milk production that they wanted to have covered. They wanted 1 million pounds covered, but they were only able to sell, or they only produced or provide receipts for 800,000 pounds. That dips below the threshold of 85% being sold. So therefore, we have to reduce the covered milk production. So based on that 85% threshold not being met, we're going to reduce the covered milk production down to 941,176 pounds. Our yield adjustment factor is remaining the same at 0.98. Our final revenue guarantee was decreased a little bit since we're covering less milk, but the actual milk revenue is also less in this scenario. So that gave us another revenue deficiency of $3,929, which we multiplied by the share and the protection factor to arrive at an indemnity of $4,715. I use this example to say that of the values that you, the farmer, are reporting, the declared milk production or the component levels, so the butter, fat, and protein content within your milk, it's very important that those numbers are accurate. There are some penalties for not having accurate numbers on that, not meeting the 85% threshold of milk production or the 90% threshold on the component values that you elected. But it's also not extremely punitive. You know, the penalties are there. They're not extremely stiff. The thing is, though, and the situation that we really want to avoid by having accurate values all the way through the policy is that we don't want insureds to be paying extra premium for coverage they're not receiving. We're not allowed to give any premium refunds if a number is misreported on covered milk production or component levels. So it's really important to just have an accurate number on that and be confident that that number is something that is realistic for your farm when we're writing this policy. Okay, so in the event that there is a loss in the market price, what we, the insurance company, will do is we'll send out a notice of probable loss to the insured. What this is going to do is notify you that based on the market decline, it's probable that you're going to have a claim payment coming to you. So at that time, and that'll happen 10 days after all the data is received from USDA on this policy, we'll send that out. And at that time, you, the insured, along with your insurance agent, will be completing what's called the milk production worksheet. So this milk production worksheet is going to provide records from the dairy farm's milk cooperative or their milk handler. It's going to correspond with the quarter insured. So all the sales receipts from that quarter will be provided. It should be noted that if you chose the component pricing option, your records should show the component levels in the milk that was sold. I had a question come up in an earlier training. You know, do these records have to be daily? And the answer is they should be. They don't have to be daily, but they should be all the records that you're getting back from your milk handler. I know certain milk handlers may pick up on a bi-daily basis, and that's totally acceptable for this policy. However your milk's being sold, those are the records we need. Again, we have to deliver 85% of the declared milk production that you're going to be covering. Otherwise, your loss is reduced and the premium is not adjusted. And if you choose the component pricing option, you have to meet 90% of the component levels for butter, fat, and protein that are being insured. All right, so as I'm approaching the end of my time here, I just wanted to go over a couple of coverage strategies with the group. I think one way that dairy revenue protection is going to be very effective is using it to lock in a price floor on some or all of the milk that you're going to be producing in that quarter. Based on some discussions I've had with dairy industry folks, this policy is less expensive than putting in calls or puts on the board. So it may be a good opportunity to lock in that price that you need. And then if the price declines anywhere from that, you'll be indemnified through the insurance company. The second coverage strategy is you're allowed to take out multiple quarterly coverage endorsements for the same quarter. So, I would recommend towards the beginning of the quarter, locking in some, maybe half, maybe 2/3 of the milk that at the price that's needed to meet your operating costs and your break-even costs. If the price goes up, you're free to lock in more coverage on the remaining milk production that is not yet insured. That's going to give you some kind of tiered pricing, and maybe you can trigger indemnity on some of the milk, if not all of it. Lastly, and I mentioned this one earlier, coverage levels. So with the current depressed pricing for the dairy industry, many people believe that we are close to the bottom of the market, if not at it. Based on that information, it seems very, very unlikely that we're going to have price fluctuations of greater than 10% on a decline. With that said, I think that the 90 and 95% coverage levels are the way to be looking at this policy. If you see a quote and the 80 or 85% coverage are extremely, extremely cheap, that's because that is unlikely to pay. This policy has a mechanism that, based on where the current prices are, premiums adjust, and where we're currently at with pricing, 90 and 95% seem to be the most likely ones triggering an indemnity. I did mention that this is a subsidized product. These are the subsidy levels by coverage level elected by the insured. 70% carries a 59% subsidy, all the way up to the 95% coverage level, carrying a 44% subsidy. All right, a couple other coverage strategies. The class pricing option is easier for record keeping. Again, that's your blended average of Class 3 and Class 4 prices. But the component pricing option is going to allow greater customization. So again, those herds who are producing higher levels of butter, fat, and protein should certainly explore that option, because it's going to cover the prices, that the premiums on price that you're getting for having a high performing herd. The second item is that class pricing can be used to match the milk check. Since we don't require records to match how the milk was sold on the class pricing option, you do have the ability to elect a higher price by going with more of the Class 3 price than what you actually sell at. But if your policy doesn't match your milk check, you're not gonna get the benefit of receiving coverage on the fluctuation in each class of pricing. So I would strongly encourage to have your policy set up the way your milk's actually being sold, as far as a blended average of Class 3 and Class 4 pricing. All right, and my final slide about dairy revenue protection is just a few items that I think are going to make writing a dairy revenue protection policy successful. And the first is utilizing the dairy experts. The Farm Credit Group is extremely well equipped to write this product based on the span of different options that they have and the different dairy experts and insurance experts that they have under one roof. I've already taken questions from insurance agents and the dairy experts and business consultants that Farm Credit has. Those folks are working together and really working to put together an extremely detailed and risk management plan for you, the insured. These folks are working together to run scenarios of what will work on this policy, and they'll be keeping you up to date on what the latest information is for it. In initial meetings with your agents and the dairy business consultants, I think it's very, very important to find those break-even costs and the prices needed to meet your operating costs as a dairy operation. From there, we can keep an eye on the futures prices, and when our prices get to those levels, we can lock in coverage and be able to react when the market meets our needs. Lastly, I did already preview policyholder services, but I think that's a great tool for those of you who stay very up to date on the market. After you fill out a dairy revenue protection application, with your farm credit agent. They can help you get set up with policyholder services. That's going to allow you to go in and use Rain and Hale's quoting tool. Very intuitive and easy to use tool. And you can set those class prices and see what the values are established with those. So lastly, I just want to thank everybody for giving me the time to talk about dairy revenue protection with you. I'm more than happy to answer any questions right now, and I'll be staying on the line till the end if any more questions roll in. So, thank you.
Great, Zach. Absolutely. Well, thank you. I do have a couple of questions that came in before I turn it over to Jeremy. Question: when is the premium due?
Yeah, so premiums are due after the end of the insurance period. So,
okay, so basically not at the signing of the contract, but in a sense at the end of the time period covered.
That's correct, yes. So
Okay,
in situations where the insured was paid a claim, we would just deduct the premium off of the claim, and then you would get the remaining money that is due to the insured.
Okay, great. And another question came in terms of how the producer sets the volume of milk insured. So I just want to kind of clarify as you go back to your example, and maybe you could flip back to one of your examples there. So the 1 million pounds that you used, was that based? How does the producer, in a sense, validate that amount in terms of their coverage?
Yeah, so I guess for example purposes, I'll say that this dairy operation produced 2 million pounds of milk per quarter historically. Based on most dairy farmers know exactly how much they are producing. So in this example, they said, I'm not quite sure if I want to lock in all coverage right now, but let's lock in half of it at this time. And then at a later date, if I want to insure the other half, I certainly can do so, but you're not required to. So it's simply just a insured election of how much protection how much of their milk they're looking to protect.
Right. But in that scenario, so let's say this producer they saw a price they liked, they did want to lock in on all 2 million per quarter that they're producing. How does the program would require them to, in a sense, prove that that's consistent with their historical production, I assume?
At claim time is the only time that we're going to ask for records on milk production. Okay. So. Okay.
But again, the indemnity would be paid on this amount that you've set, when you create the policy, as opposed to what your actual production was during that period.
No. Okay. So if we look at this example again, this insured said that they had 1 million pounds.
Why don't you go back to the one where the actual production matched the insured amount?
Sure. I think it's going to be important to look at both to answer this question, okay. But we'll start here. All right. So in the scenario where the declared production met the actual, that means that we don't do any recalculations. The insured proved that they had at least 850,000 pounds of milk sold, which met their minimum. And in our scenario here, they proved that they had the full 1 million pounds. So that means we're not going to change a single thing about the policy. The way they set it up was accurate, and therefore we're going to pay them on what they expected at the beginning of the insurance period.
But let's say in this scenario, they actually made 1.1 million pounds in that period. They get paid on the million, correct?
Correct, because that's what they declared at the beginning of the insurance period.
That's the point.
That's what they wanted covered.
Great.
In the event, though, that the insured overstated their production at the beginning of the insurance period, they insured more milk than they actually produced. When we get those records at claim time, we are going to have to reduce coverage based on what was actually produced then. And it's not a full reduction. It's a reduction off of the 1 million pounds that were declared. So again, just being accurate with those initial values, if you're going to be insuring all of the milk, is extremely important.
And so in this scenario, let's say this producer had made 950,000 pounds of milk in this period. Would they be covered for the 950 or the million that they originally contracted?
They would be covered for the full million because they met the 85% threshold.
Okay.
You have to produce 85% of what you declared on your initial values.
Okay, great. All right. Well, thanks for walking through that. That's very helpful. We've got a couple questions in on that. Good. Okay. Well, Zach, well, if you can stay with us, that'd be great. And then I think at this point we will turn it over to Jeremy, who's going to talk to us about LGM dairy.
Great, Tom. Are you seeing my screen?
We're seeing the notes version.
Okay.
If you want to hit the slideshow piece.
Let's bring.
You can go up to display settings, Jeremy. Yep.
Oh.
Perfect.
Great. Thank you. Well, thank you everyone for joining. This certainly, as we've talked about, is a timely topic, and especially with the dairy revenue protection plan, it's a good opportunity to not only be aware of the new product, but also what is available out there for USDA and the Risk Management Agency products. I'll spend time going over the Livestock Gross Margin Dairy Program, and this is a program that we have been delivering and providing to producers since 2009. In 2011, though, is when we really started to gain an increase in interest, and what happened in 2011 was the Risk Management Agency provided premium support that made the program much more affordable. And what also started happening at about that same time was there was a significant increase in feed cost. So you've got a product that became much more affordable. Then you had increase in feed cost, which really put pressure on the margins. And that's where we started to really put out the effort to hold producer meetings, hold similar webinars like we're doing today, educating producers on the product. And over that period of time, seen quite a few producers develop plans, stay the course with this plan, and benefit from having that strategy of risk management, market protection, as well as margin protection. Another important change that occurred this past year, which was significant, especially with the introduction of dairy revenue protection, was the elimination of a $20 million livestock program funding cap. And that funding cap had put some constraints on the availability of livestock products. And with that being removed, we now have dairy risk management products that are much more available to producers without the concern of funding limits and availability. So those were some things that had changed. And looking back on my time and participation in the crop insurance program over the last 20 years, today's available risk management options for dairy producers offered by both USDA and the Risk Management Agency provide the dairy industry with many options, tools to have to be able to put together a sound risk management plan. So where we were 20 years ago, 15, 10 years ago, compared to where we are today with the available risk management options, we're in a much, much better place as to be able to protect that volatility. We've already talked about the disclaimer a little bit earlier. The one point that I'll really emphasize here is when understanding program details, we have the agent force that's out there that's able to help producers know the details of the program, and that's really what I would encourage everybody to where everybody should start, is with an agent. So our topic is going to really go into what is the Livestock Gross Margin Dairy Program, how it works, and also how to determine if it's right for your business with the multiple options that you do have. What is LGM Dairy? Certainly, it's a dairy risk management program that's specific to Class 3 milk price. So I think this is important to differentiate between the dairy revenue protection. Is this is specific to Class 3 milk price. What it's also looking at, because it's margin-based, margin protection, is feed costs. So we're looking at corn and soybean meal off of the Chicago Board of Trade. And what you'll have as a producer is you'll have a gross margin. So that gross margin is that Class 3 milk price minus your feed costs. And we'll get into whether it's feed costs off, feed values off of a default or your own actual feed. We'll get into that in just a moment. And then another option that you have is what deductible range are you going to use? So what's your deductible choice? And the range is from 0 cents deductible up to $2 in deductible. So we'll go through that as well. One important point, and we talked about in 2011 when premium support was provided for the program, I'll say a very important point is that to receive that premium support, that subsidy, we must enroll 2 or more months. So this program, you can purchase it on a month-to-month basis, but to receive that premium support, you must enroll 2 months at a minimum. And you can go 10 months if you'd like to, but 2 months at a minimum to receive that premium support. The premium subsidy levels, as you saw in Zach's presentation, they range depending on the coverage level. Here they range depending on the deductible level. So example, at the 0 cents deductible, you have an 18% premium support. 50 cents deductible, you have a 28% premium support. And then from $1.10 deductible up to the $2 deductible, there's a 50% premium support. So certainly making the program affordable. And in a moment, we'll go through a loss example and coverage example to show you what the cost of coverage is. So this is another important discussion with an agent. And a lot of this depends, when it comes to deductible, a lot of that depends on your risk tolerance. This is really discussed on an annual basis, could be a monthly basis, based on risk tolerance and based on what margin is available to you from the futures to be able to protect. So how does LGM Dairy work? Again, we're going to start off with the Class 3 milk price, and producers get to choose, similar to DRP, producer, you get to choose as how much milk you want to enroll. One of the differentiating factors between dairy revenue protection and livestock gross margin dairy is there is a cap, and that cap is 240,000 hundredweights during the insurance period. You can choose 1,000 hundredweights, 10,000 hundredweights during that period, but cannot exceed 240,000 hundredweights. Flexibility to this program, you get to choose which months you want to enroll. A typical strategy that we had seen over the life of this program is the furthest out months, which is pretty similar to what Zach talked about with those further out quarters. There's typically less information available, more uncertainty. This is a discussion again between the agent and yourself as to what period of time are you most concerned with. what information are you reading as to that could potentially impact certain months and certain periods of a year. The other one, again, is the producer choosing the deductible. Again, a very important decision based mainly on risk tolerance and what are you looking at for trying to budget for a cost associated with risk management. So I think that's an important point there that plays into the decision making. A really important point that I think we've done a good job over 10 years, almost a little over 10 years of delivering the program is the mailbox price that you receive for the milk is not taken into consideration. Similar to dairy revenue protection, all the prices that we're using are based off the Chicago Mercantile Exchange, Chicago Board of Trade, and not based on the actual price received. This is another factor that plays into your coverage level choices, and this is which feed values are you going to use. And I will say that of 95% of the LGM dairy policies that we have in place, if not even more than that, they choose to use default feed values. So these are set feed values that, keeping in mind is an estimate of what it costs, values of what it takes to produce 1 hundredweight of milk. And these values have made it easier for the default feed values have made it easier for producers to participate in the program because you do not need to provide any feed records to support the amounts that are being used. If we choose to go to your actual feed values, then at that point, it's a fairly easy process, it really is. We have a system that takes all of your feed values and all your ingredients, your rations, and we can convert those rations to corn and soybean meal equivalents. So it isn't a difficult task to do the conversions, but it's recognizing that if you choose to use your own feed values, then in that situation, we will have to be able to provide the insurance provider the records to support what was actually fed. So know that you do have an option here, but also know that certainly the majority of producers elect the default feed values. We're going to jump into a coverage illustration here, and let's say we're looking at enrolling in October of this month, and we have a monthly option of when to enroll. We'll get to that in just a moment. And if we saw a Class 3 milk price on the futures at $16 a hundredweight, and we chose to use the default feed values, we're looking at a cost to produce that at $2.50 per hundredweight. In this scenario, the producer elected a 50-cent deductible, and they know for the period of time that they'd enrolled that milk, the months that they chose to enroll, that there's a gross margin guarantee of $13. In that situation, again, we know that milk minus feed cost minus deductible, $13 gross margin, and then we wait to see how the actual milk price and actual feed costs come in. And in this scenario, we're going to assume that the milk price went down and the feed price increased. So we had Class 3 milk price originally at $16 a hundredweight. That dropped to $14.50 a hundredweight. And we had feed costs, so corn and soybean meal, we had that previously set at $2.50. That increased to $3 a hundredweight. So we have an actual margin differentiating ourselves from any price at the mailbox price or farm price. So again, our actual margin came in at $11.50. In that example, again, $13 was the gross margin guarantee. Actual gross margin coming in at $11.50. we have a gross indemnity at that point of $1.50 a hundredweight, and the estimated payment, so premium payment, is 32 cents per hundredweight. In the end, that producer knows that they have $1.18 coming to them. Certainly, understanding what's going on in the market, understanding what can influence the market, needs to be, from our perspective, from an agent's perspective, this needs to be a monthly conversation. We generally start our conversations about a week before the enrollment date, and the enrollment date, we'll talk about that in a moment. It's the last business Friday of every month, and we're looking over the available months to enroll, talking about what we see going on in the market, where there is risk, whether it's milk price going down or feed costs going up. So this is a monthly discussion that we're having with producers. One of the tools that we use is sending out a coverage illustrator, an email to, I believe that reaches almost 300 producers monthly. And if that's something that you would be interested in participating and receiving, let us know, let your local crop growers agent know, and we can get you on that mailing, that email list to get that report. Again, in this situation, we had a 50 cents deductible that was elected, and then the milk revenue calculated was based on the covered period of time. Working with an agent, and I believe that John Lair is going to go into this real well here a little bit later on, but when working with an agent and deciding if the program is for you, it really does start with knowing your cost of production. We do have some tools to help you determine that, and we have the Farm Credit East Dairy Profit Analyzer service, evaluating what your greatest risk is. And that, again, is a conversation that you could have with the Farm Credit team as a whole, identifying where you see the greatest risk, again, whether it's milk price going down or feed costs going up, or if we're in a situation where we have both of those factors playing into creating a potential risk. Another item is understanding the relationship between the futures prices and your own mailbox price. Again, differentiating which, delivering the program as long as we have, I'm not very concerned about the separation of the two, but it is something that we certainly are aware of and make sure that our producers are comfortable with understanding. Cash flow, understanding what your needs are, understanding the timing of payments and how that impacts. So there is, once the futures have been released and we know what those prices are, there is a period of time of approximately 45 days of knowing that once USDA, the risk management agency, releases those prices, then we have, they are reviewed and then released approximately 45 days after the insurance period. Another important factor that I'm really pleased with many producers that we work with, staying the course with your risk management plan. Risk management isn't and can't really be looked at as I'm in and I'm out. In that situation, you end up potentially missing the time and place when you need the program most. So staying the course, always very pleased to see the producers that we're working with making monthly decisions and participating on a regular basis. Looking at the advantages and the disadvantages of both of LGM Dairy specifically here is customization. So there's a lot of flexibility with the program as to the amount of production. One of the questions that carried over with Zach was how much milk to enroll. Well, we look at trying to keep a 10 to 15% buffer on the maximum amount of milk. We don't want to find ourselves in a situation where our milk production coming in significantly lower than what we enrolled, and then it impacting a claim payment, but yet at the end we end up paying a premium for that. So we want to avoid those situations. Choosing the time period. When are you most concerned? When do you feel that there's great risk? Or do we stay with the strategy of staying out the furthest 3 months that's available to you and just continuing to roll with that strategy? That's a very good one. Use your choice of the deductible. Depending on if we're in a situation where we see that we may have not as much downward pressure, okay, that dollar deductible might be the place to be. If you feel that we have significant downward risk and potential, maybe we need to move that deductible to a 50 cents or something different. Another advantage is that you can start out with a small amount of production, learn the program, and then learn how it functions, and then make decisions later on with increasing your amount of milk enrolled. Again, affordable premiums, we talked about that with the premium support. And then an important point is that this program, while we'd never want to give away any of the highs, this program is a floor without taking away or having an impact on losing out if the market improves. Some of the disadvantages, again, I'm not too worried about this, but I think it is important to just separate ourselves between the mailbox price and what we're looking at on the Board of Trade and Mercantile Class 3 prices. Feed conversions, if you choose to use your own feed rations, again, we've got a solution for that of using default feed values, not really concerned about that. And then the short sales period, and hasn't been an issue in recent years, but last business Friday of the month and the enrollment period once the prices get released, which is about 6 o'clock on Friday until the following day at 9 p.m. We've been in very good shape for being able to serve all producers without having any major concerns there. Just addressing the sign-up process, as Zach did as well. Monthly enrollment, again, the last business Friday of the month. Best thing to do in that situation is to talk with an agent a week before the enrollment date about what information is needed, what the margins are looking like, where do we see the risk, and then determining how much production we want to enroll, and then whether we want to use the feed values, the default feed values or your own feed values, and then choosing which insurance period, so the month that you want to enroll milk in, and then that gives a good perspective there. Important point is when our premiums due, and they are due at the end of the insurance period. So example, if we enroll in October 2018 and our premiums will be due October 2019, if we find ourselves into a claim situation, the indemnity payment will come right, or pardon me, the premium payment will come right out of the indemnity payment. So little perspective on LGM Dairy, and looking forward to if there's any questions now or at the end, but thank you for that opportunity.
Great, thank you, Jeremy. So no specific questions right now on LGM, but obviously, folks, just as a reminder, if you do have questions, you can go to the GoToWebinar dashboard and type in a question where the red arrow is. So certainly, if you do have questions on LGM Dairy, we can get those to Jeremy at the end. But now, why don't we turn it over to Clark to talk about, give an update on the MPP program.
Good afternoon, everybody. I wanted to go over the margin protection program. Most everybody that's milking cows has heard about the margin protection program. It was part of the 2014 Farm Bill. Producers were allowed to enroll in 2015. 2015, you had an option to enroll in 15 or 2014. Most people already knew what the margins were for 2014, so they opted out of that and they participated in 2015. Most people can remember 2014 was a very good milk price year. 2015, the prices were starting to decline. We had a fairly significant enrollment in the program the first year. As the price started to decline, producers were actually wondering where their MPP payments were, but yet the margins never really got to where producers benefited much from the program. If you had bought maybe an $8 margin protection, there probably was months that you actually could have got paid. Some of the highlights of the margin protection program is that it does expire in 2018 with the end of the 2014 Farm Bill. So anybody that's going to benefit from the program right now is already enrolled in the program, and that will come to an end in December. There is talk in the next Farm Bill negotiations about what a dairy program will be. At this point, we're not exactly sure. Changes to the 2018 margin protection program allowed for some producers to benefit from the program. When the Secretary of Ag, Sonny Perdue, was appointed, one of the things that he did was he allowed producers to withdraw from paying the administrative fee for 2018. A lot of people did that because they didn't see any benefit for the program prior. So a lot of people opted out of the program for 2018, and then I want to say maybe it was like January or February, the prices were starting to decline even more. The Secretary enabled or allowed producers to enroll in the program for 2018 after there was already calculated payments under the program for February and March. So producers actually were allowed to sign up for the program after the fact. Premium costs were decreased for producers that could cover 5 million pounds of production or less. That was actually another incentive for producers that could cover the 5 million or less to enroll. So we had producers with 20 million pounds of production or less that actually enrolled and have been receiving payments under the program. Some of the program proposed program under the next Farm Bill, the House has a version and so does the Senate. The House version is a dairy risk management program. Margin covered and percentage of milk to be covered under MPP or under the dairy risk management program would remain in effect for the duration of the whole 2018 Farm Bill, which is different than the 2014 Farm Bill because producers had an option actually to change that from year to year. With this version, you would have a one-time chance to lock in the margin as well as the percentage of milk covered. So at this point, we're not exactly sure what's going to be, but that is the House version. And the maximum margin coverage for the House version would also be increased from the $8 maximum under MPP to the $9 a hundredweight. Senate has their own version. Dairy risk coverage is what the title of their program would be. The premium cost will be increased significantly compared to the margin protection program. And there's a provision in there for small and medium-sized farm premium discounts. So producers whose annual production would be less than 2 million pounds, they would get a 50% discount on their premium costs. And then if you made between 2 million and 10 million pounds annually, you would get a 25% discount. So actually the House and the Senate each have their own version. they're in the big picture, they're similar, but yet they each have differences, and the Farm Bill at this point is in conference, and they're waiting to hammer out some sort of a decision between the two as to which version they're going to try to make the 2018 Farm Bill. The only thing I would say is, in closing, it's interesting to hear about the Dairy Revenue Protection Program, because that actually could be used in combination with the MPP. I'm assuming that it will be available for the 2018 Farm Bill Dairy Program. LGM Dairy, as Jeremy spoke, producers cannot participate in LGM Dairy and in the MPP program at the same time. They have to choose one or the other. In closing, one thing that I would say is this program, or the MPP, is not for everybody, but yet there's some people, I think, that could benefit from the program. Everybody has their own risk, and not everybody's risk is the same. So, and Zach and Jeremy have both touched on that, and I would say the same thing, that there's a chance that everybody could benefit from one of these programs, I think. So that's all I've got, unless somebody has any questions.
Thank you, Clark. Appreciate the update. Maybe just a couple clarifying things before we turn it over to John Lair, our business consultant. So I think, just to kind of summarize, in terms of the Farm Bill kind of having expired without an extension, certainly the people who are in the 2018 program, I mean, they're not affected, correct? I mean, so in terms of if they would be due payments, you know, for the latter portions of the year, they would still get those. Is that correct?
That is correct. The MPP program is authorized through December of 2018.
Okay. But your point in terms of going over what the House and the Senate versions are about a new program, in a sense, following the end of December, you know, at this point, there's not an MPP program authorized for 2019.
That is correct.
Okay. Okay. Well, good. We'll appreciate the clarification. We'll see if, I don't think there are any other questions on NPP at this point, but if you as well could stay on the line, that would be great, and see if any other questions do come in.
Okay,
so I think
thank
at
you.
this point, I think at this point, we're going to turn it over to John Lair, who I introduced earlier at outside of the program, who's a business consultant, and ask him kind of for John's thoughts on, what considerations should producers take into account as they're looking at their options about, which programs might be right for them. John?
Tom, can you hear me okay?
Hear you fine. Yep.
Good. Good afternoon, everyone. My goal today is kind of bring this full circle with the three programs that were presented, and with my role as a consultant, as an on-farm advisor, kind of to spin it to what would a producer do in preparation or on the farm to get a better handle of which one of these tools may be, or combination of tools may be the best suited for their farm. So when I first sit down and talk with producers about this, I try, as does our crop growers team, try to figure out what their goal for the risk management plan is. And that's not always as simple as it sounds. I'm quick to say doing nothing is speculating, and doing 100% of crop insurance or something else is speculating. The answer falls somewhere in the middle. And one of the things that kind of stuck with me as we did a practice run earlier in the week, and I give Clark credit here, he made the term manage to your own level of risk. It's not just managing your risk, it's managing to that being the key concept, and having an understanding of what those risks are, where you're vulnerable in some parts of your business and may not on others, and no business is the same as anybody else. Good example of that, and I'm quick to say, if I've got 8 or 10 months of forage carryover, I might not need as much crop insurance. If I've got low debt and I can handle some price swings, I may not need any of these products. But the converse is true, is if I've just gone through a major expansion, or as we're in this prolonged down cycle that I'm using up some of my liquidity, maybe these programs become more important than where I have been in the last 5 years. The other piece of the goal, determine the goal for your risk plan, is what risk are you planning for? Is it fire? Is it weather? Is it key employee turnover? Is it estate transfer? Today we're talking about the financial or the market price risk, but trying to understand, you know, as we look at the market risk, there's two fundamental forms that this can take. This is a kind of an interesting concept that I've had with brokers out of the Midwest is, are we trying to make money with these programs, or are we trying to limit loss? And those are two fundamentally different concepts. You know, if you're trying to make money, then we have to be a little more in tune with the markets and our financials, more than just, you know, having an understanding of what my cost structure is to try to limit loss, and having a conversation with your lender in terms of, all right, if I'm going to limit loss to this level, you know, where's the source of liquidity for that? And those are very, very different philosophies and take different liquidity levels. The other piece of the puzzle that I do on the farm is the producers that participate in these, and over the years, they need to have very strong financial insight into their own business. I've had instances over the years where somebody said, I use this program, and my first question is, well, what was your cost? Are you limiting loss? Are you making money? And the answer is, I don't know. And I think that's a very wrong answer in terms of, if you're going to use any of these products, you need to have strong financial insight. Ironically, this week, as we were preparing for this, and I had, you know, made a note to myself to talk about the strong financial insight, Dr. Dave Cole wrote his newest article in the Ag Globetrotter, where he describes about business and financial IQ. And interestingly, I could tie 9 of his 15 factors back to this concept of business insight, which is predominantly financial. 3 particular pieces of the puzzle that I want to bring up here is, we hear a lot of rhetoric on knowing your net cost of production, which is very, very important. You need to know, you know, what be that on a per cow, per hundredweight, per unit, per acre, whatever commodity we're dealing with, we need to know that. You need to know the industry standard on how that's calculated. And I'm quick to use, you know, if I hear a $13 net cost production on a hundredweight, as diner talk, is what's missing in there? Is depreciation not in there? Is family living not in there? We need to know the understanding of the industry standard, so you're comparing apples to apples, as well as when you're dealing with these products. There's a lot of talk about net cost production, but in my opinion, that's the second most important number that you need to know. It's not the first important. The first important number is break-even cost, because break-even cost ties to the cash flow. I'm oversimplifying it, but the difference between net cost of production and break-even is simply substituting depreciation, which is a net cost of production, which is a non-cash number, with the principal that you pay the bank. And then any business that has any amount of leverage in paying that on reasonable terms, 90% of the time, your break-even cost is higher than your net cost of production, but you need to understand that and why. These numbers are critical so that you know what your risk tolerance is, can be, or should be. The third piece of this puzzle, and it tied into Jeremy's LGM discussion, is you also need to know what your historical, current, and projected milk basis is. If you're doing the LGM, which is a class 3 product, your mailbox is much different. If you're doing the DRP program, which is a class 3 and class 4 product, you need to understand what your class 3 and class 4 basis is. And basis is simply the difference between what Chicago tells us and what your mailbox price is. A lot of milk handlers can provide that for you. Our on-farm consultants can help you calculate that, and understanding which direction the markets are going is very important as this financial insight as well. Once we have those numbers and we understand our cost structure and profit structure, are we in a good situation, bad, or just average in terms of how much risk management we truly need to do and which products we need to use. The other is we're gaining this insight to understand where our businesses may be out of balance. And that can be both in a good way and a bad way. Good example right now is, the dairy industry is not in expansion mode. There's a lot of dairies with too many heifers. To say, is that a financial drag on the business? Is there a way to, adjust your net cost for production or break even? But this insight is necessary to help create the appropriate risk and financial plan for the future of your business. Additional sources of liquidity as you're doing these products. Is your line of credit available? Is DRP going to provide a plus or a minus to the cash flow, depending on the premiums and the timing of that? Milk handler programs as well, if you're locking in some milk price. All of those are very, very important to have an understanding and share with your trusted advisors as they're trying to help you come up with a plan from all angles. As I bring this full circle today, I tried to write down takeaways from each of the three presenters earlier. With Zach's on the DRP program, I think my big takeaway from that was the flexibility and the ability to layer some contracts. The flexibility also ties in whether you're doing a class 3 or class 4 versus some components. On Jeremy's LGM discussion, my takeaway is, we really need to have an understanding of what we think that compression on that margin is going to be. Do we think milk price is going to go up, down, or be flat? Do you think feed is going to go up, down, or be flat? As you're making that decision to say, should I do that or not? And then on Clark's MPP, my takeaway is to be determined, as to how the Congress will proceed with that. Some of the tools that I use on farm and our team uses on farm is advisory teams. So it's not just one person advising. You've got your crop grower's agent, you've got your lender, you've got your consultant, your accountant, all of those putting their heads together to help you come up with the best risk management plan for all those reasons that we talked about earlier. I and my consulting team use the Dairy Profit Analyzer extensively, which is a monthly production and financial budget tool, so that we can actually determine some seasonality within your business. And that was one of the other takeaways I had regarding the DRP program, which is a quarterly program, to say which quarters are you locking? Do you have some milk depression in terms of production with heat stress in the summer, or feeding green silage in the fall, that your middle and later quarters may be less milk produced than the first quarter, which tends to be very, very strong historically. But understanding those and seeing those in front of you is a great visualization as you're making decisions. The other piece is, it's critical to know those costs. I can't stress that enough in terms of your net cost of production and break even, to say, are we locking a portion of this into a loss or a gain as you move forward with any of these products? And I think this is an exciting time right now where you've got a variety of programs that you can tailor and customize to your own individual needs. So with that, I will turn it back over to Tom or Jeremy. Thank you.
Great. Hey, thanks, John. We'll appreciate your insights on that. Obviously, a lot of things you got to consider. One question, I'll stick with you here, John, for a second. As you look at LGM, and you made the point about, obviously, the price portion of that is tied to class 3, whereas in the dairy revenue, you can get a blend of 3 and 4. So obviously, you got the basis risk on the price side. And now, would you say that has Class 3 historically, and I know this may, you have to generalize here a little bit, does it kind of move consistently with mailbox prices in the Northeast that you found, or not? And certainly, Jeremy, you can comment on that too.
I can't say that moves consistently at all.
Yeah.
Okay, so
If that was the case, it would be much easier to predict and do some of that. It really depends on what market utilization and what's, going on in the world that drives each one of those markets.
Because I know obviously the actual level is going to be different, but so you're saying that if, let's say for the period you're looking at, 9 months from now is, the Class 3 price is, $16, and, if it dropped by $1, you're saying that it's not that predictable that necessarily that the Northeast mailbox price would drop by $1 as well.
That's correct. I cannot predict that because you've got the other thing that is factored into the basis is PPD, and I don't want to get into the weeds on that, but depending on how Class 3 and Class 4 moved in relation to each other, and where the Class 1's closed, PPD can have wild effects on each of those. So it's not that easy.
Gotcha. Well, and that's obviously one of the points where we can't get into those weeds here in the webinar, but obviously one of those considerations that we got to take a look at. And I'm going to take a kind of follow up on a previous question that I had with Zach. Zach, as we were talking before we turned it over to Jeremy, going through the example with, kind of an example of how the indemnities are calculated. You talked about, when we talk about the kind of the actual revenue piece of that, obviously we talked quite a bit about how the amount is determined in terms of the producer selecting that amount, when they put the policy in place. When we look at the price side of that, when we talk about the actual price, that price is sort of it's really the same calculated price, whether it's a combination of Class 3 and Class 4 or components that you set, basically that you set the policy on when you put it in place, not the producer's actual milk check price. Is that correct?
Yeah, that's accurate. The actual revenue is calculated using the averages from CME during that 3-month insurance period.
So if you'd said, let's say you did 50% Class 3 and Class 4, when you set it for that time period, at the end of that period, you're just basically going back to that same 50% weighted Class 3 and Class 4 to, in a sense, get the, quote unquote, actual price that happened, then multiplied times the production amount that had been contracted for. Is that fair?
Yep, that is correct.
Okay, great. And then, and Dick, while I got you on the line here, a question came in. Someone asked whether or not there were options for organic. Are there under this program?
No, there are not. But the organic, I would recommend taking advantage, number one, of the component pricing. You can get a little bit better prices through that. And then second, that protection factor. If I had an organic farmer approach me about dairy revenue protection, I'm automatically bringing that protection factor to 1.5.
Okay, good. And Jeremy, I'm assuming LGM also. I mean, how does organic factor into on LGM?
Tom, not as well as dairy revenue protection. So that protection factor is exactly that. And Zach, great, you nailed it. That was exactly where my thought was. From LGM, we really don't have that factor. We don't have a component to address. It's right in line with Class 3 milk price.
Okay. And Jeremy, another question that had come in, they wanted you to expand on an example of where the deductible comes into play with LGM Dairy.
Yeah, so the deductible is going to look at the gross margin, and then it's going to, so we'll go back to, do you want to go back to that illustration? I know we've got some time here.
Okay.
Let's see if see if we can go back to that illustration. So the deductible, let's see, are you seeing, oh, hang on just a moment, let me accept, let me know when that comes through.
Yep, we're seeing it now, the gross margin guarantee slide showing.
Okay, so in this scenario right here where we are, this is the producer signing up for the coverage, say October 2018, and we're looking out at the period of time that they're looking to enroll. We've got a $16 hundredweight price that we're seeing. We've got the feed cost equivalent coming in at $2.50. If that deductible election was $1, now our gross margin guarantee is $12.50. So if we're now, let's follow this through. So you've got a $12.50 gross margin instead of that $13. In this situation, we're going to have perfectly fine. We got the $14.50 class 3 price. We've got the feed cost that went up a little bit. The actual gross margin came in at $11.50. So we're going to have $12.50 as our gross margin guarantee here instead of that $13. So now you've got a difference of, what do we have there? Actual came in at $11.50, $12.50. So you're at $1 gross indemnity instead of that $1.50. Now you remove the premium cost, and that it's all going to play through the whole process. So that deductible is directly going to impact the trigger point in which the program's going to respond and result in an indemnity payment. Depending on what's going on in the marketplace, $1 had typically, from cost perspective and trigger point, has been a fairly good place to begin. We had a period of time in about 2013 where we had many producers jump in to try to keep their costs low, a couple cents, around 5 cents per hundredweight, but they were choosing the $2 deductible. And we were watching this take place with other agents, and we said, we didn't agree to that strategy because that means that the margin has to drop more than $2 to see the program provide the producer with any benefit. So that was a strategy that we didn't fall into. Even though the cost was cheap, what you're giving up was so much more. So $1 to the 50 cents to $1 range deductible, that's a fairly good place to be from a cost and trigger point perspective. So I hope that answers the question.
Yeah, I think it does, Jeremy. And maybe I think you had another slide that just talked about, because obviously the trade-off here is in terms of premium level. You did have a slide up, I think, that showed what the premiums were, or the premium subsidy were, not the premium, but the premium subsidy was relative to. So certainly that kind of factors in terms of, obviously the higher the deductible, the lower the premium, but then the higher level of support. So those are, I guess, the kind of things you got to look at as you're kind of choosing what level works for you. I guess, and I think this make this kind of the last question. I haven't seen any new ones come in, but kind of leave with, for you and John, kind of similar to my question to John about how the basis on the milk price. Talk a little bit more about the feed component on LGM, how, in terms of the calculation of that and what producers' costs, purchase feed costs would be here in the Northeast, how those kind of move together, what things do you have to take into account as you look at an LGM dairy contract?
Tom, good topic to bring up and discuss. So over the years of working with LGM, our agents would go through the evaluation of the feed rations, and we take all that data, run it through the conversion, and what was really interesting was that the default feed value, so it was an exercise, and it was an important exercise that agents and producers were going through, but in the end, the default feed values tended to be in line in line with the corn and soybean meal equivalents. And if we saw a benefit to going to the actual producers' feed rations, we were ready to make that shift and capture all of those feed ingredients, those feed rations, and all the items that made up that feed ration. But we didn't. It was almost a moot point when running that exercise, and that's why today we're at that 95, and I have no problem in saying we're at 100% of our producers using the default feed value. So there really wasn't much of a benefit gain by going through and using your own. What you really did was you subjected yourself to having to support your feed rations with records. And I hope that answers the question, but really, thanks for bringing that one up, Tom.
Yep. No, that's good. John, any comment on that you found?
One of the things that did not get brought up is like the other source of risk management is you can actually, particularly on the feed side, you can lock your protein and energy needs as well for the underlying commodity, as well as lock some basis on those products, a lot of times with the feed vendor. And that's important for us to know as well as we're coming up with these risk management plans to say, you know, you could be doing too many things as well versus the appropriate amount of measures. But the feed is a little bit unique, is that you can also lock the underlying commodity as well as the basis on it.
Okay. All right. Good point. All right. Great. Well, so we don't have any other questions. Jeremy, I guess I'm just going to leave it to you if there's a final comment before we close up shop here.
Yeah, there really is a couple of points. First of all, thank you to everybody that attended today. This is an important topic, one that we are committed to, helping our producers be aware of the available products. I want to thank Zach, who we are partners with in educating producers on the program. Clark, thank you. MPP is an important program, and one that we need to make sure that all of our producers know and are comfortable with, and especially as we go through the next several months of becoming aware of what the new version, in a sense, is going to be. And John Lair, thank you so much for the time. You know, one of the things that I've really respected within the Farm Credit Consulting Group is their independence. How they work with producers, how they communicate. Really, we are a source of information and education, and that's really our role is from a crop insurance perspective is we're a program, a support system. Obviously, all day, every day, our team develops risk management plans, but I really have respected the relationships with the consultants because of their independent nature. So from a producer perspective, I would say utilize the team of specialists that you have. Where we are today compared to where we were 10 years ago as to the products that are available, the resources that are available, we're in a much better place today to manage risk, and it's a matter of knowing your options. I will put a point out, and we'll end up on a positive, but you know, one of the things that we've heard over the years is failing to plan is a plan to fail. We're in a much better situation today with the resources that are available. Let's not find ourselves in that situation. Zach had mentioned dairy revenue protection becomes available next Tuesday, October 9th. One of the benefits of the program is a daily enrollment. So that's a positive to flexibility. What I would encourage for our dairy producers, contact an agent and at least establish a policy. Set up that policy. You're not committed to enrolling a quarterly coverage endorsement, but also what it provides you is access to their quoting tool, their quoting illustrator. Very intuitive, very easy to work through. I would say get comfortable with it, because when you hit that price, as Zach said, when you hit that price that you know is going to protect your cost, that might be go time. equate go time to September 2014 when we were serving producers on LGM dairy, and that our ability to communicate with producers quickly, because we did a lot of education on the front end, a lot of producer meetings, helping them be prepared. And when we got to September 2014 and where Class 3 milk price was, to our team, it was contact everybody. Let's make sure that everybody's in a good position if we've got that much downward risk. Visit with your crop insurance agent. Crop growers, again, we've got 26 team members serving Pennsylvania, New Jersey, New York, up to Maine. Take the time to spend with them. Also, I want to let our New York dairy producers know that the week of October 22nd, we are firming up 4 in-person dairy risk management, almost identical to this, but it's going to be in person. And we'll have 4 meetings, one in Western New York, one in Northern New York, Central and Eastern New York. So more details will be coming out on those. Look out to our crop growers website, look out to our Farm Credit East website, and for details on those meetings. And we'll be sending out postcards here most likely next week to get the message out about that. Tom, Heather, thank you for hosting the webinar. Really appreciate the opportunity. I hope in the end our commitment is to providing value, and I hope that we did that through today's webinar.
Right. No, absolutely, Jeremy. Well, thanks to you and John and Zach and Clark for joining us today on the webinar. As you can see on the screen, certainly the materials in the replay will be available at farmcrediteast.com/webinars. And you can always contact Chris Lawton, our Director of Knowledge Exchange, for more information about upcoming programs. So again, thanks to everyone for joining us, and hope everyone has a great day.